Really excited to have Rachel Ziemba with us. Rachel's somebody that I've seen a number of times in various Fed and NABE related venues. She is a policy expert on a number of things, but her expertise really is focused on not just the economic, but market impacts of different policies, particularly things like sanctions. She likes to call them coercive because they are. They really skew things and markets in different ways. Some for the good and some for the bad, depending on which side of the coin. If you're being sanctioned or being kind of cajoled to do something else. A big chunk of her time is as an adjunct senior fellow for the Center for New American Security in the Energy and Economics and Security Program. She's also a senior advisor for the Horizon Client Access, track and development, certainly along those sanctions and those sort of policy things, particularly for areas like China and Russia and Iran and other areas of the map. Previously, she's done a number of things, including stops at Rubini Global Economics, among other places. And some of her work has been cited most notably by the IMF, among other bodies, but also as governments and others that she has helped advise. So a plethora of things that she's done and a very wide background as far as places that she's helped out. So really excited to have Rachel today. We're going to start out today. Rachel's going to give an overview. Then we'll get into a little bit of a sort of fireside chat between the two of us. Please enter in as you think of things into the Q&A. Fill in your questions and we'll try to address those. If we don't get them to then we'll get to just the open Q&A at the end. So with that, kind of open it up to Rachel. And if you would, share your slides or whatever when you're ready, we'll go from there.
Thanks very much, Mike, and thanks to all of you for being, sort of joining today. I know it's a busy time of year, and so really appreciate it as we're all sort of thinking about next year and moving forward. And it's been a real pleasure to chat. Sorry, guys. To chat with Mike about a whole number of kind of global issues. I started out very much as an emerging market and energy economist, sort of market macro strategy. And I fell into thinking very much about these policy tools that are aiming to channel and restrict market access. And of course, it's interesting to me because I started my career tracking sovereign wealth funds and tracking other ways that governments, particularly in the Middle East and in China, were trying to reshape markets. And so it's interesting to see some of those tools and a whole spectrum of tools being used in countries like the United States and elsewhere. So I'm sure we'll get into that. I pulled a couple slides together, maybe a few too many, but we'll try to look through it. And I'm happy to circulate these after the fact. We can coordinate through the club and I'll probably post it somewhere as well. But just really trying to put a couple ideas on the table of what are we learning? What have we learned about some of the episodes recently, particularly around Russia, but also an escalation of use of sanctions against China and other countries, with the guise, hopefully, of kind of teasing out some impacts, especially for currencies and global economy. And I realize I had the date wrong on that slide. So I figured what I thought I'd do to kick off is kind of just set the scene a little bit with some of the tools that have been used, because the scale of it, I think, is pretty unprecedented. Talk a little bit about how maybe these interplay with other global trends, supply chains, as we reach new phases in the pandemic, as we reach new phases of policy normalization, and try to sort of, as I say, tease out the impacts on currencies. And, try to bring up a few issues ahead around especially payment systems and issues like central bank digital currencies, but that may end up getting pushed to the Q&A. But there's some key things to watch here, both as they impact how a major sanctioned country like Russia is interacting with the global economy, but also as we watch countries like China and how they balance their sort of, different goals. So, and, I'll probably spend a little bit of time about whether some of the tools we're using now, whether it's things like the oil price cap, that I've spent a lot of my time studying in the last few months, or other restrictions, how those might lead to unintended consequences that might impact the U.S. and sort of allies' roles in the global economy. And that's a lot to do in a few minutes. So we'll just try to put some ideas on the table. So I'm not going to go through this whole slide in detail, I promise you. But I put it together because it's more to sort of send a message of the wide range of tools that have been used on Russia this year. Some of them already had been used to a lesser extent in 2014-15, and over the last few years after sort of the seizure of Crimea and parts of the Donbass. But I think it's useful kind of to highlight the wide range of tools that are being used. I often talk about the US government, its allies using all the tools. And those are things that range from the use of extraterritorial financial market access, trade restrictions such as export bans, import bans, use of things like the foreign direct product rule, which are expanding the use of export controls. That's very important for Russia, but it's even more important for China, which I think we'll get into. And of course, of interest to many of us in the markets, things like bans on security issuance, sovereign debt, corporate debt, elsewhere. When some of those were coming into effect some years ago, they seemed very dramatic for a country, and I think they still are, but for a country like Russia that didn't have a lot of need for capital flowing in because it was choosing to forego growth and investment, the actual economic impacts have been less extensive. And then, of course, there are also future investment bans. And of course, we've seen a lot of companies exiting Russia. Now, one of the things that was unique about the Russia sanctions package was that this was one of the first times that I could think of where you had a major provider of food and fertilizer and agricultural products being sanctioned. Often sanctions officials try to have humanitarian exemptions so that medicine and food can get into a country. This was one of the first times where there was a much more extensive focus, after the fact perhaps, on how do you get those items out. And of course, the cost and the like was amplified by the fact that this was a situation of war, and not only Russian supplies, but also Ukrainian were restricted. And the other sort of point to leave you with on some of this is that elements of this package are already being used on other countries, both smaller ones, ranging from, earlier this year and last year, places like Ethiopia, Myanmar, but also elements of this are being used on countries like China, which will have, which are unlikely to be as comprehensive as those in Russia, but they're already having meaningful impacts on investment decisions and the like. So I talked about one way in which the Russia sanctions package was unique. The other ways are just the scale, the number of participating countries, the number of tools being used, the preparation ahead of time. I mean, this is one of the first times where I was aware of US government and allies directly almost briefing the press about things that they would do. Now, of course, the deterrence didn't work or didn't work well enough. But that sort of sending a message through market channels even before sanctions are implemented is an important element. The size of the target. People spend a lot of time saying, well, Russia's economy is not that big. It is, of course, a G20 member, but its role and weight in global energy markets, of course, is up there sort of at the top. And so that is a very unprecedented situation. And that's one of the reasons we've seen the measures on the energy sector looking very different than the sanctions on Iran or on Venezuela. And of course, the fact that sanctions and other factors remain to continue to keep Iranian and Venezuelan oil offline constrain, some of the Russia policy decisions. I mean, if Iran and Venezuela were producing at their max, we still probably couldn't take all of Russia's fuel supplies offline, but it might have some sort of room for maneuver. The speed of action, right? The waves of sanctions coming fast and furious, particularly back in February and March, but even sort of throughout the year, and the degree of diplomacy, this is unique. And that I think had a lot to do with the severity of the situation on the ground, the fact this is happening at a time of war, and interstate conflict. The role of the private sector was very important. Now, sanctions often create incentive structures for private sector actors to comply or over comply, right? There are enforcement actions, there are penalties, but those take time to investigate and enforce. And the main way that the US bodies like OFAC and the like operate is by sort of creating an incentive structure and fear even that leads the private sector to comply. Here, I think that was amplified by stakeholder pressure relating to the war. And so we actually saw a lot of issues of overcompliance. Companies that were sort of reluctant to do things that were theoretically legal and maybe even encouraged by the United States and its allied governments, like providing food and fuel trade or medical trade, or even legal energy trade. And so I think that creates more challenges for markets. Now, and then of course, this is also happening when the US is using many new tools against other countries deemed competitors. Now, I've spent a lot of time, in the last few minutes talking about all the restrictive tools. The other thing I think that's relevant for market actors is, of course, that at the same time that all these restrictive tools are being used, the US government is doing a lot more what we might call industrial policy efforts to incentivize new investment, whether it's to sort of reshore activity or the like. And those create their own both incentives that can lure capital. And we can talk about how far and effective those are going to be in semiconductors, critical mineral supply chains for EVs. But they also they can create challenges with allies, and we can sort of go into the sort of issues that are sort of at play with the US and European Union, for example, on these sort of protectionist acts. So just briefly on Russia, just to kind of go into a little more detail. Overall, most of the sanctions, in my view, in my analysis, did more to cut Russia's imports than they did to cut their exports. The latter is changing for Russian-owned decisions. And imports as well have started to stabilize from some countries. What you see with the chart that's on the left is that there are a couple of countries where exports to Russia in dollar terms have returned to or even exceeded the levels that they were at in the sort of fall of 2021. Now, in this chart that I have here, Turkey is, of course, the outlier. Turkey is really stepping in as a major intermediary. Other countries like Kazakhstan and elsewhere that are part of an economic area with Russia as well. China has returned to its previous trade relationship in dollar terms as well. Other countries, developed economies, the sanction sending countries, of course, have not. And even countries like India, which you see is the green line here, have really, they've stabilized, but they've had a bit more trouble sending items to Russia. Now, the other thing I would say that we find from all sanctions sort of episodes is that as you sort of restrict financial access by the banks, as countries are limited to the number of trading partners they can that are willing to do business, of course, they become even more price takers on global markets. So even though some technology items are going to Russia from China, the quality of those goods is likely diminished. Now, that's the point. The point of this whole exercise is to raise the costs for the Russian state and apparatus and national balance sheet of conducting this brutal war. And it's worth noting that that's a shift in the goal that sort of came about in probably March of 2022. Before that, it was a lot about policy change. Now it's really about how do the US and allies degrade Russia's capacity. Now, as I mentioned, exports had been a little stronger for Russia. That had to do with a couple of factors. One was that energy trade wasn't constrained and very much until now, until very recently, with this oil price cap that caps the level at which trading buyers of Russian fuel can pay if they want to use G7 services. So if they want to use a Lloyd's shipping insurance syndicate, if they want to use a Greek shipping firm, it needs to be below this price. While countries like the United States, Canada, and Australia banned fuel imports from Russia fairly early on, these are countries that didn't really buy much oil from Russia. And so the fact that the European Union is stopping the imports of seaborne oil is a major deal. The other factor, of course, as we often see with countries in some form of a balance of payment stress, is that imports contract, imports contract, and of course the sort of net exports contribution to growth strengthens. Now, in this case, I've just said, well, the sanctions regime cut imports, but also the Russian coping mechanism for dealing with the financing pressures was to hike interest rates up a lot. And that, of course, led to even more sort of restriction of consumption and the like. Now, some of those trends have moderated in that Russia was able to move away from very defensive monetary policy. But ultimately, the set of policies, the sort of lack of fiscal space, the disruption of Russia's mobilization are really leading to a new leg down in Russia's economy. So I just summarized here that Russia's economy is suffering, but it's surviving at a lower level where it continues to contract. But this is not a collapse. And that was, I think, something that we learn also when we look at the agency and examples in countries like Iran, where there are certain resilience sort of elements. And my reason for bringing this up is not to say don't do sanctions, but maybe be realistic about how much time they can take to have implications. The other takeaway from my research is to note the ways in which sanctions may exacerbate the consolidation of power within a regime. Now, we alluded earlier, the big impact for the global economy of this episode was through the commodity markets, particularly energy and food. Russia wasn't a major revenue source for big global companies, important for some energy companies, but was a major supplier of energy to many Asian and European countries. And that, of course, has been something that has led to and exacerbated the energy crisis in Europe. A lot of German companies are really grappling with what their sources of competitiveness will be going forward now that they can no longer rely on cheap gas from Russia. But other countries as well, places like Japan and elsewhere, who had looked to Russia as one of the sort of supplies going forward, are really having to rethink that. And of course, this was all happening at a time when you had a differential exit from the pandemic, or at least from the pandemic lockdowns. And so that this was going on and exacerbated some of the relative strengthening of the US dollar, the weakness of Asian and European currencies, the sort of defensive, hikes in some countries, I think reinforce some of the impact there. Now, of course, for some of the Asian trading partners of the US, so not only China, but also Southeast Asia, some of the impact of all of these trends on the balance of payments was partly offset by the strength of U.S. demand, and we can get into that. But notably, the tariffs on China that remain in place have contributed towards some migration of certain goods to Southeast Asia. They're still being imported by the United States, but they're coming from a slightly different Asian source, and the like. Now, on currencies, what I also wanted to kind of, Lisa, before we go into sort of Q&A, one of the very unique tools used this time, or escalations, was the freezing of Russia's central bank reserves, or immobilization of the reserves, on the 27th, 28th of February this year. Now that there have been other countries whose reserves were immobilized, places like Iran that barely had any money offshore, and the like. But this was sort of in the neighborhood of $300 billion worth of assets that have been immobilized. There's some question mark about whether the officials actually know where all of these assets are. The Atlantic Council has done some interesting sort of work on that. But when that happened, there was both concern about what message it would send to sort of holders of U.S. treasuries and central bank reserve managers in places like China or the Gulf states, places that hold a lot of U.S. assets, and whether that would spark a greater move away from sort of the U.S. dollar. So far, that doesn't seem to be the case. I think there are a few reasons for that. One is that the G10, the G7, and the G10 did it together. So in a sense, if you parked your money in European banks, it didn't help. Those assets were also frozen. If they were in Norwegian banks or Canadian banks, and the like. The other, of course, is that this was happening at a time of sort of major moves, as I've just alluded to, in the dollar index, and the like. And the other structural issue continues to be limitations on some of the alternatives to U.S. dollar, sort of U.S. dollar assets. For example, the limitations on assets, on what one can buy in China. And of course, this was happening at the same time that not only were there sort of COVID lockdowns restricting Chinese financial markets and activity, but also at a time where the crackdowns on technology companies in China contributed to some question marks about both sanctions risk, but also Chinese risk. Now, I think there's some important things for us to watch, and maybe we can talk about more in the Q&A. And that's the dynamic that these sort of currency issues we've sort of been talking about have led to a period of relatively less reserve accumulation in emerging markets and actually disaccumulation, sales. I just pulled up the COFR data on the right-hand side there. And I'm sorry, there's no timeline at the end. It goes through Q3 2022, which is highlighting that reserves in US dollar terms, have fallen. This is partly a currency valuation story. The dollar value of European, of euro holdings, of course, is lower. But even if you look at the sort of dollar share, or not the share, sorry, the dollar value, they've also gone down. And that has to do with the fact that some countries were pulling on their reserves to restrict, to help private sector actors, pay for their costs. The other thing that's happening that's relevant is that some of the countries that do still have current account surpluses and are having some reserve accumulation pressure are shifting how they manage their assets. Some of them, Russia, of course, has a strong reason to do that. And my best guess is that they're parking the money they are earning and some of the as yet unsanctioned Russian banks. But there are also decisions in places like Saudi Arabia that have led to a shift in how they manage their foreign assets. In Saudi Arabia, that of course this year has had quite a strong external balance as oil prices picked up and their production picked up until recently, right? But that has happened at a time when Saudi Arabia began managing some years ago its foreign assets in a different way. Its sovereign wealth fund, the public investment fund, invested much more in equities and in strategic stakes in the U.S. than it did than the central bank, which did invest in equities, but mostly was holding on to sort of U.S. Treasuries. So people asked a lot of me sort of whether we're going to sort of see whether we're going to see the Saudis depeg, whether we're going to see a lot more use of the renminbi. The jury's still out sort of on that one. And I think medium term, there may be these risks to the US dollar. In the short term, I think that there are limitations of both what a country like Saudi Arabia could do with its renminbi it acquired if it suddenly started to be paid for a lot of oil in renminbi. It's also not clear to me that the Chinese are comfortable with with a lot of internationalization of their currency. Now, that doesn't mean that American policymakers and others should rest on their laurels. It's never a comfortable thing to be saying, well, it's not in China's interest to internationalize its currency right now, so breathe a sigh of relief. But I think it's important for us as economists to look at what tipping points might be. And some of the tipping points I see on the renminbi side are around not only convertibility of the currency, but also how the domestic securities market evolves, whether the sort of, and especially whether one can do other things with renminbi than just buy sort of Chinese goods. Finally, before sort of, going to sort of questions, I think it's important to talk a little bit about sort of alternate payment systems. Russia struggled so far to find alternate payment systems to the sort of North Atlantic dominated global financial system. They did succeed in shifting over a lot of their domestic transactions to the Mir network that replaced what had been cards that were run by Visa and MasterCard. But that was really for domestic transactions. And that might have gone smoother than some of us anticipated. What they really struggled to do, and you can see this in this chart that I've sort of pulled from the work of my friend Alina Rybakova at the IIF, is the way in which these foreign transactions have really collapsed. Now, Russia is using the renminbi more. Corporations are issuing locally in renminbi. The renminbi has a bigger piece of a much smaller foreign currency pie in Russia. But overall, it is really constrained by the fact that China is reluctant to let renminbi be used between Russia and other countries. And I will say that an effort a couple months back from the US Treasury to place various Russian actors that were involved in the national payment system and the Mir network on the SDN list, it's a sanctions list, and then to warn counterparts in Turkey and Kazakhstan and India that they might face secondary sanctions has been pretty successful in limiting those transactions. So that again becomes something to watch. The other thing I'm really sort of watching in the coming months going into next year is how oil markets get reshaped and energy markets more generally get reshaped by things like the oil price cap. Now, the oil price cap, as I mentioned earlier, really just targets oil that's moving by sea. And if you want to use G7 services that currently dominate seaborne oil, then you have to pay less than $60, and you have to attest to it and sort of prove that that's the case. The trend so far, the goal of that was to cut Russian revenues, but to keep the oil flowing. And that was with the idea and concern about what the impact on the global consumers and of course the U.S. consumers of higher oil prices. Overall, if the goal was trying to sort of keep global oil prices from rising too far, I would say it's had a relative success. Um, where one of the things I'm watching for is whether there start to be alternative payment systems, not payment systems, delivery mechanisms, and maybe payment systems delivered that are now more involved in oil trade. Theoretically, buyers could use Russian insurance or Russian tankers. It remains to be seen how much volume will sort of take up there. My assumption is that countries like China will buy some oil under the price cap system. They'll buy some oil under these new channels, these new alternatives. And some of it might be outright, sort of smuggled and sort of, sort of black market fuel. After all, Chinese buyers have purchased some several 100,000 barrels a day of effectively smuggled oil from both Iran and from Venezuela. But I think we'll continue to see this bifurcation or maybe multifurcation of sort of, oil market sort of transport. The other trend that we are seeing is that the oil price cap and other dynamics are lengthening the sort of transportation time. Oil and products are spending more time on ships, either because they're going to a country for refining and then they're coming back to Europe, or because fuel that went through pipelines to Europe is now going on boats and is going longer journeys. And that, of course, will have implications too for the cost of shipping, especially of the products going forward. Now, we don't have too much time to go into some global trade issues, but maybe we can come back to it in the Q&A. But some of these same trends that I'm talking about, or comparable trends in the energy markets, we are seeing, with other sort of shifts in supply chains. And I'm sure you all have spent a lot of time mapping the supply chain impacts and disruptions relating to the pandemic, and we're also seeing a dynamic where, coming out of the pandemic, we're seeing a number of countries that got a wake-up call about the concentration of their semiconductor inputs. And so we've seen countries ranging from Japan to, of course, the United States, really trying to incentivize more sort of local production. Now, this both takes time and it has a lot of costs. But this is a reflection not only of pandemic-related supply chain issues, but of course, increasing tension between the U.S. and China, especially over Taiwan, and the like. We are, I think, in a world that is very much that is undergoing selective deglobalization. It's not overall decoupling and the like. As I alluded to earlier, the U.S. is buying less goods from China directly that were subject to the tariffs put in place in the Trump administration. But American consumers continue to buy those goods from other Asian countries that likely have significant Chinese inputs. And overall, of course, U.S. imports from China continue to be sort of, quite high. So, and I think as Mike and I were chatting before the thing, when we look ahead at sort of U.S. Sort of tariffs and trade policy, a number of these elements, are, especially as they reflect China, are quite bipartisan. And so there are issues ahead that we can get into about how the U.S. will sort of grapple with, on the one hand, reducing the reliance of the U.S. and its allies on China as a key node in the supply chain, but also how it will balance and avoid, and how it will balance the interplay with its allies, including in Europe. Now, with that, I think I'll stop. I've overrun my time, but I hope I've left you some sort of food for thought, and look forward to the conversation and all of your questions.
Absolutely. Great overview of some of the key points there, Rachel. I'll briefly take a quick second to mention, of course, the Q&A is open. There's one question out there we'll get to in a second, but please put your questions in the Q&A and we will definitely get to them. In the meantime, I have lots of them. And certainly you touched on a number of areas, but just like to redirect a little bit and come back to, I think one of the key ones, and you didn't say it this way, but essentially the weaponization of the dollar.
Yes.
Just to expand on that a little bit. And we've also seen the round trip of the Dixie, the DXY, in recent months. So lots of things are happening, of course. But just talk a little bit about this, expand on this concept of weaponization. And, there's a number of folks out there, experts as well, that have said, basically, you get to do that once, and then some of these bad actors might, disengage from global payment systems. So again, just touch on that if you would.
Yeah, no, I will. Yeah, I mean, you're right. I mean, and I think there's been this escalation in the types of targets that have been cut off from either the dollar sort of market, or as I say, one of the things I think is somewhat unique about Russia was actually pretty much all of the G10 currencies for the banks that were cut off. And that makes it quite different than, for example, I mean, it's been notable to me that with Russia, the US hasn't used a lot of what we, sort of might call secondary sanctions. So those that use the US extraterritorial power to say, well, if you as a third country actor, so maybe you're a Turkish bank and you're transacting with Iran, you might end up on the SDN list and lose access. Now, the reason they didn't do that is partly because the Europeans, all the G7 sort of, the UK sort of agreed. And so there's not a lot of alternate sort of systems one could use. Now, of course, there are some alternate systems. I didn't talk about cryptocurrency very much. And there have definitely been some increase in volumes. That being said, I think the US Treasury and its counterparts are trying to kind of catch up on some of that. Sometimes you end up with blunt tools there. Right. So things like there's been a lot of talk about the sanctioning of this crypto mixer called Tornado Cash. I must admit, until it was sanctioned, I didn't really know what a mixer was. I'm not an expert in cryptocurrencies. So full disclosure there. But I'm interested in anything that impacts sort of global payment systems and global balance of payments and the like. So I try to. So a mixer is something where different entities sort of engage in transactions, but the identity is more hidden, and the like. And of course, that's the kind of thing that U.S. and counterparty regulators don't like. And in that case, there was a lot of evidence that the North Koreans were using it, which was the reason why it was sanctioned. So one of the challenges with cryptocurrency is that even as the scale and volume has expanded, it's nowhere near enough to kind of take the place of global currency markets, even for some of these commodities. So I do think there's more transactions going through underground and illicit channels, but not really at scale. Right now, the question mark we're watching for is when might that change? And that's where I keep coming back to kind of watch China and the like. China, well, they have an interest in making it more difficult for the US to weaponize the dollar, weaponize its markets, and to constrain China's supply chains, which of course we are doing in the United States. But they also don't really want a lot of illicit actors to sort of come in and undermine their own financial markets and the like. And if anything, so in some of China's previous plans, they talked a lot about the dual circulation system, right? Trying to kind of deepen, domestic production, deepen supply chains, as well as to boost their exports. If anything, a combination of domestic constraints and of course, COVID issues and the like, I think have led to China really diving deep on getting its own financial infrastructure working, the sort of digital CNY, as well as the new pressure to try to de-Americanize some of their electronic supply chains because of measures like the export controls that the US imposed on October 7th that both limit China's access. And I know I'm now talking about weaponizing a completely different supply chain than the dollar.
And it's
but I do think they're linked.
Oh, go ahead.
Yeah, all I was just going to conclude with is that so they cut off China from the most advanced semiconductors, which of course were generally being made in China. So there's some enforcement issues there, and some limitations of how far can we go in the short term of reducing reliance on China, or what does reliance on China mean? But also stopping China from purchasing some of the equipment they would need to make those. So those include things like lithography machines that ASML, the Dutch company, is involved in. The latest rule, and it was interesting to me that the US imposed those measures unilaterally when over Russia and the like, they've tried to have some allies together. Subsequently, though, it looks like key allies like the Dutch and the Japanese have, are sort of coming to some agreement, partly because the US said, well, if you don't agree, then we'll make you subject to the foreign direct product rule, and you still won't be able to export. Now, the foreign direct product rule basically means that if there is an item that has US intellectual property in it that's sort of on that list, a foreign company can't export it. Now, there's still an issue of the US government and others knowing that product is there, and that's where I think that threat probably works better on allies, where you don't want to be the company that has a really large fine and gets banned from the US market. So in a sense, the weaponization of the dollar in part was, I think, an effort to kind of deal with countries and entities where there might not have been a lot of direct US trade. It was an attempt, if we look back some years with Iran, to target the actors. But of course, we're now in a point where we have a lot of countries that are subject to maximum pressure sanctions. I don't think Russia's one of those countries yet. I think there is some room for escalation. I also think there are limitations when a country is as big as Russia. But yeah, I think there are certain things that it might be hard to sort of, redo. And I think to get to the sort of implication of your question as well, there are a lot of folks in Washington that looked at the success, or that the coalition coming together and some of the initial impacts and said, oh, maybe we can do this to China. And that always worried me for a variety of reasons you can imagine.
Right.
But that question mark, not only about the integrated supply chains, but also the integrated financial markets and other channels. So you may be able to do it more than once, but I do think there are externalities, and there are consequences and discontinuities that sometimes can be hard to estimate. So, for example, I alluded at the start that that in a sense, some of the sanctions, like the central bank ones, were so extensive that it led to companies saying, "Well, we're not sure if we want to do even legal trade." So, I think that's an issue as well.
Yeah, which dovetails into the question that's out there about these sanctions against Russia, and essentially it hasn't really changed at all what Russia's behavior is, at least not outwardly, and certainly not from a military standpoint. Do you think that this really changes the impact of these sanctions? Is it likely that the effect gets greater over time? There's some sort of cumulative effect, or do you think there's there's limitation to this? You just touched on it, partly because of their size and their importance in global markets,
Yeah.
particularly energy markets.
So I do think that these measures do grow over time. I think we're seeing some of that. Now, of course, the challenge is some things can grow over time. Some of it people find workarounds. Now, I recognize those are two inconsistent points, right? And that's a balancing act. So what I think we're seeing with Russia right now is that on the one hand, some trading partners who back in the spring said, I don't know if Russia can pay me because of sanctions. Maybe they can't pay me because they have their own capital controls, right? Because a sanction targets have agency as well. Like sometimes, in the US, we think about, what we can do to sort of others, and, and other allies do that as well. And that's sort of multiple kind of degree kind of chess. sometimes that can be harder to predict. Now, I mean, we do have smart people sitting, we've got a lot of smart people sitting in Treasury and all these people that are doing that. I don't mean to underestimate that. I'm just saying that, it can be hard to kind of play through in that mindset. So I think what is becoming more and more challenging for Russia, I think, is getting some of the inputs that they need. So maybe they're getting by with buying household appliances and taking the chips out of that and putting them into military equipment. We are starting to see some of that trade actually shut down. So some of the issue is that sanctioning entities might choose to sort of escalate. So you say, okay, here's a loophole. This is going on. Okay, let's close that loophole. But that's it's an iterative process, and there are costs to it, right, as well, right? But I do think that what is also happening, I mean, Russia struggled in this period between 2014 and now to reduce its reliance on foreign inputs. Like, it reduced its reliance on foreign capital, but it didn't reduce its reliance on sort of the import channel. And that's something that, of course, there's a sort of a sudden stop in a sense. They're having to from some of the best quality inputs, and they're having to adapt. But I do think, there's a lot of evidence that a combination of the export controls, plus even the way in which, as Russia both has lost some human capital, but is also deploying a lot of human capital into the military, that I think it leads to a very different economy. Now, that's not necessarily great news for us if our ultimate goal, the ultimate US policy goal and allies, is to stop this war and to make sure Russia isn't going to do this again, and other countries won't do it again. But to the point, and there's a good question raised by Perry, of this didn't change the policy. Historically, I think there was always maybe sometimes a fig leaf of, the goal of sanctions is to change policy. There are a few examples where policy change resulted. We can look at sort of Iran and the lead up to the JCPOA. There's some different questions of, what about South Africa under apartheid? There's some other cases, but what I think a lot of people are sort of coming to, of course, is to realize that in some cases you can end up with countries able to survive for a period of time and a consolidation of power within a smaller degrading sort of country. But that doesn't mean that they don't have power in that way. And that's where I do think it was notable that the US goals, of the sanctions shifted quite quickly to this degrading the capacity to wage war. Now, I think if a US policymaker was here, they would say that the fact that Russia is relying on drones from Iran, not from other input, sort of says something about, how there's some cut off. That doesn't mean that Iranian drones can't be effective, and the like. Maybe they're different in that way. And it's notable to me that China is not providing military equipment to Russia, and I think that's partly their concerns about U.S. sanctions, but it's also partly their own concerns about what Russia's doing. So I think that the degradation of the military supply chain is something that is growing over time. But the risk is that this could drag on for a period of time. And Russia has clearly showed that they don't really care about losing economic strategic interests, right? I mean, in service. So, I didn't talk about it too much, but this choice to cut off natural gas exports, even when they're not sanctioned, sort of to Europe, I think is an important, sort of element of that. Russia for a long time, really tried to emphasize that they were a reliable supplier. That's obviously out the window. Now they could say, well, you're not a reliable customer, so why should we be a reliable supplier? But I think that element, as well as the fact that, of course, that fear of mobilization in the war has led to quite a sizable amount of some of the smart, private sector folks to sort of flee to neighboring countries. So I think this will build. But yeah, often, sanctions are not sort of a quick win. Some of it is about buying time for the other more direct or indirect military support. And of course, there's a really big question down the line, even when there is, and I hope there is soon, some sort of military sort of resolution. of what's going to be the set of things that go into taking the Russian assets, and maybe, do they get them back? Does it get seized and go into sort of some fund for Ukraine? There's all sorts of things kind of, sort of still out there.
Right. Only got a couple of minutes left. Very quickly, kind of softball question from, kind of these Russia, oil, dollar, currencies generally, balance of payments, all that. What keeps you up at night from those topics?
I would say the risk of major sanctions and escalation sort of being used on China, and the sort of deterioration of the U.S.-China relationship, right? The risk of sort of, I think it is a good thing that President Biden and Chairman Xi talked, and that there is some sort of discussions, but I do think that the divides between the countries are going to continue to grow. And, sort of something going sort of wrong as we're sort of using some of these tools on China, and China might come up with different coping mechanisms. So and maybe that's also coupled in with, of course, I'm still worried about, debt dynamics in a number of countries, not so much developed economies and maybe really in big emerging markets, but sort of, how China copes with its domestic property, property debt. We're entering into a year, there've already been some frontier market debt defaults. I don't think that creates a contagion wave throughout financial markets. There'll be a lot of chatter about that. But I am worried about the kind of growth crisis that is implied by the higher debt service payments that we're seeing in a number of countries, whether it's places like Brazil or, elsewhere, and what that means to those sort of broader policy sort of agenda.
Yeah. We could talk for a couple more hours, but unfortunately we're just respectful
another time.
For everybody's time. Can't thank you enough, Rachel. And thank you everyone for joining us. We will have a January AEC webinar. We'll see exactly what that ends up being. At this point, we're still in flux as to what the topic is going to be, but we'll get there. In any case, thank you for your time. Thank you again, Rachel, and have a great day, everybody, and happy holidays.
Thanks so much for having me. Thanks to all of you for your time. I appreciate it.